Your employer is offering you free money every single year, and most people never touch it. Not because it's complicated, because nobody explained it. And here's my honest opinion. That's not an accident. What if there was a savings account that gave you a tax break when money goes in, grows completely tax-free, pauvre, and you pay zero tax when you take it out? Triple tax-free. No other account in the financial system does that. Not one. Your employer tells you about the 401k, they mention the health insurance, they walk you through the dental plan, and then they hand you a form for something called an HSA and say it's just for medical expenses. Sounds logical. But here's the flaw. That framing has cost the average worker over $100,000 in wealth because what they didn't tell you is the part that matters. In 2023, Americans left an estimated $35 billion in HSA benefits sitting unused. $35 billion. Just sitting there, unclaimed, uninvested, forgotten. Because nobody explained what it actually does, and the real reason your employer skips the full explanation. The less you use it strategically, the less it costs them. Stay with this, because what you're about to learn isn't a life hack, it's a legal, documented, IRS-approved wealth-building machine that most people are walking past every single day. This isn't about health insurance tips. This is a breakdown of the most powerful tax-advantaged account most workers have access to and have never been properly taught how to use. The math is real. The tax advantages are documented. And by the end of this, you'll know exactly how much this account could be worth to you over the next 20 years. Here's what most people believe about the HSA. You put money in. You use it to pay for doctor visits and prescriptions. And at the end of the year, if you didn't spend it, you lose it. Sounds logical. But here's the flaw. That's not an HSA. That's an FSA, a flexible spending account. And the fact that most people confuse the two is the most expensive financial mix-up a working adult can make. Here's a contrarian idea. Most financial advisors won't say out loud, the HSA is not a healthcare tool. It's a retirement account disguised as a healthcare tool. And the people who understand that distinction are building serious, quiet wealth while everyone else is just managing medical bills. Let's be clear about why this confusion matters. An FSA, the one most people think of, has a use it or lose it rule. You put money in. You spend it by December, or it disappears. So people treat the HSA the same way. They contribute a little, they spend it on copays, they move on. And this is where most people fail, because the HSA has no expiration, no deadline, no spend it or lose it. The money rolls over every single year. Every single year, it compounds, it grows, it waits for you, and it can do that for the next 20, 30, 40 years. Now, let's talk about what makes this account unlike anything else in the tax code. Most accounts give you one tax benefit. Your standard savings account? No tax benefit at all. Your 401k. You get a deduction going in, but pay tax when you take it out. Your Roth IRA? You pay tax going in, but it grows and comes out tax-free. The HSA, tax deduction going in. Tax-free growth inside. Tax-free withdrawal for qualified medical expenses, that is 3 separate tax advantages on the same dollar. No financial product in the world is structured that way, and it's sitting in your employee benefits portal right now. Here's my opinion, and I'll stand by it. If you have access to an HSA and you're not maximizing it, you are voluntarily paying more tax than you legally have to. That's not a strategy. That's just uninformed. You're probably wondering, okay, but do I even qualify? Here's the requirement. You need to be enrolled in a high-deductible health plan, an HDHP, that's it. If your employer offers an HDHP option, which most do, you can open an HSA. And in 2024, you can contribute up to $4,150 as an individual, or $8,300 as a family. Every dollar of that contribution is tax-deductible. Meaning if you're in the 22% federal tax bracket, that $4,150 saves you $913 in federal taxes alone, before it's even done anything else. This is the part people overlook. Every HSA account comes with a cash holding option. Most people stop there. They let the money sit in cash inside the account, earning almost nothing. But most HSA providers, Fidelity, Lively, HSA Bank, allow you to invest that money into mutual funds, into ETFs, into a diversified portfolio that grows completely tax-free. And this is where everything changes. Let's run two scenarios. Same person, same income. Same HSA contribution. Person A treats their HSA like a medical debit card. They contribute $3,000 a year. They spend it on copays, prescriptions, glasses. At the end of the year, balance is zero. They do this for 20 years. They saved on taxes along the way. Good, but that's it. Person B does something different. They contribute $3,000 a year. They pay their medical bills out of pocket from their regular income, and they leave every dollar in the HSA invested at a conservative 6% average annual return. Over 20 years, that HSA grows to approximately $110,000. Tax-free. $110,000 that person A doesn't have. Same income. Same contribution amount, different decision. Now here's the part that sounds almost too good to be legal. It is legal, fully. The IRS has no time limit on HSA reimbursements, meaning if you pay a medical expense out of pocket today and keep the receipt, you can reimburse yourself from the HSA 10 years from now, 20 years from now, after the money has been growing tax-free the entire time. So you're not just saving on taxes going in, you're letting the government's money, the tax savings, work for you for decades, then pulling it back out, tax-free, whenever you want. That is a legal arbitrage most people will never know exists. Let's talk about what happens when you turn 65, because this is where the HSA becomes something most people never expected. Before 65, withdrawals for non-medical expenses get hit with a 20% penalty. That's the one restriction. But after 65, that penalty disappears. You can withdraw for any reason. You just pay regular income tax, exactly like a traditional 401k. What most people miss is this. You now have an account that behaves like a 401k after 65, but with decades of tax-free growth behind it. And if you use it for medical expenses, which you will because healthcare costs explode in retirement, it's completely, permanently tax-free. Here's a number that should change how you think about retirement. The average American couple will spend approximately $315,000 on healthcare costs in retirement. That's not a scare tactic. That's a documented Fidelity benefits estimate. $315,000. And every single dollar of that can be covered by your HSA, completely tax-free. Compare that to pulling the same amount from a 401k, where you'd owe ordinary income tax on every withdrawal. At a 22% bracket, that's $69,000 in taxes. Gone. Just on healthcare spending alone, the HSA eliminates that entirely. Here's something almost no financial content will tell you. For some people, the HSA should be funded before the 401k, not after maxing it. Before. Because the triple tax advantage on the HSA is mathematically more efficient than the single deduction you get from a 401k. Now, if your employer matches your 401k, take the match first. Always. Free money doesn't lose to anything. But after the match, the HSA argument is stronger than most people realize. Now, let's talk about the part of this that's genuinely infuriating. Many employers, not all, but many, just contribute money to your HSA. Free money, deposited directly into your account. A typical employer contribution is between $500 and $1,500 per year. Some go higher, and the majority of employees who receive this contribution spend it within 30 days on medical expenses. Gone. The truth is, that employer contribution, invested over 20 years at 6%, is worth between $29,000 and $87,000, depending on the amount. And it cost you nothing. $0 out of your pocket. But most people treat it like a gift card. Spend it fast before it feels like it's not real money. And here's why that happens. Behavioral economists call it mental accounting. Money that didn't come from your paycheck feels less real. It feels like a bonus. So the brain spends it faster and more carelessly. Your employer's HSA contribution gets mentally filed under healthcare fund, not under retirement asset. And that filing system, that invisible mental category, EIM, is costing you tens of thousands of dollars over your career. The fix isn't complicated. Move the employer contribution to the investment section of your HSA immediately, before you touch it, before you think about it. Treat it the same way you treat money you never had. Let's get specific, because knowing the concept is one thing. Knowing exactly what to do is another. Step 1. Check if your employer offers an HDHP plan during open enrollment. If they do, compare the premium savings versus your current plan. For healthy people under 50 with no chronic conditions, the HDHP almost always wins financially. Step 2. Open the HSA and contribute the maximum. $4,150 for individuals in 2024. $8,300 for families. If you can't max it immediately, start with whatever you can. Even $1,000 a year invested over 20 years is transformative. Step 3. Switch the HSA to investment mode. Most HSA providers require you to actively move from cash holding to investment. It doesn't happen automatically. Log in. Find the investment tab. Move the balance. This is the step 90% of HSA holders skip. Step 4. Pay all medical expenses out of pocket. Keep every receipt digitally, in a folder, organized by year. You are building a reimbursement reserve. Every dollar of medical expenses you pay out of pocket today is a tax-free withdrawal you can take in the future, after years of growth. Step 5. At retirement, use HSA funds for the $300,000 in healthcare costs that are coming regardless. Tax-free, penalty-free, fully funded, while your 401k stays intact for everything else. There are two types of people in every office: the ones who treat the HSA as a medical debit card, and the ones who treat it as a tax-sheltered investment account with a medical excuse. 20 years from now, those two groups will have wildly different financial lives. Same employer, same benefits package, same salary. One group has a $100,000 tax-free asset. The other group has a $0 balance and a drawer full of pharmacy receipts. The choice is the same one it always is: information, used, or wasted. Here's the thing nobody talks about. Most people who hear about the HSA strategy get excited. They open the account, they contribute, and then they make one of three mistakes that quietly destroys the whole plan. The number one killer of this strategy: you contribute $4,000. It sits in the default cash sweep account, earning 0.01%. You think you're doing the right thing because the money is in the HSA, but the account itself doesn't grow your money. The investments inside it do. Cash in an HSA and invested funds in an HSA are not the same thing. Not even close. The difference over 20 years is the difference between $40,000 and $110,000. Same contributions. Completely different outcome. Check your HSA right now. If it shows a cash balance and no investment allocation, you have work to do. Some people get the account right. They contribute regularly. But then a $200 dentist bill comes in, and they immediately log into the HSA and reimburse themselves. That's not wrong, but it's not optimal. Every time you pull money out early, you lose compounding time. $200 pulled out at age 40, Basoro, could have been $640 at age 60, at 6% growth. That gap grows with every withdrawal. Pay the dentist from your regular income if you can. File the receipt. Let the HSA stay invested. The reimbursement will be there when you actually need it. And this is where most people fail silently. They know about the reimbursement loophole, but they never build the habit of keeping records. A receipt from 3 years ago that you can't find is a tax-free withdrawal you will never be able to take. The IRS requires documentation for every reimbursement. No receipt, no reimbursement. The fix is simple. Create a folder, digital or physical, called HSA Medical Receipts. Every time you pay a qualified medical expense out of pocket, take a photo. Drop it in the folder, label it with the date and amount, 5 seconds. That 5 seconds is worth hundreds of thousands of dollars over a career. The strategy only works if the paperwork works. You're probably wondering, what if I actually get sick? What if I can't afford to pay medical expenses out of pocket while the HSA stays invested? Fair question. Here's the honest answer. This strategy isn't all or nothing. Maybe you invest the employer contribution and half of your own contributions, and keep the other half liquid for real expenses. Any portion invested is still beating the 0% return of spending it immediately. Something is better than nothing. Always. And as your income grows, you shift more toward the investment side. The strategy scales with you. It doesn't have to be perfect on day one. It just has to start. Some employer-linked HSAs are restricted to cash only. That's real. But here's what most people don't know. You can transfer your HSA balance to a different provider. Once a year, you're allowed a full rollover with no penalty and no tax. Fidelity's HSA is free. No fees. Full investment access. You take your balance from the restricted provider, roll it to Fidelity, and invest it. Done. Your employer still contributes to the original account. You roll it over annually. The restriction disappears. This one move alone, switching providers, has unlocked six-figure investment growth for people who didn't even know it was an option. This one is the most emotionally charged, and I get it. High deductible feels like high risk. But let's run the actual numbers. A typical HDHP saves between $1,200 and $2,400 per year in premiums compared to a traditional plan. That premium savings, contributed to your HSA, is already offsetting the deductible risk. For a healthy person who rarely hits their deductible, the HDHP plus HSA strategy wins mathematically almost every year. The fear of the deductible is real. The math usually doesn't support it. And here's the thing nobody says: even if you do hit the deductible one year, you're still ahead. Because the premium savings you've been banking every month covered it. Plus you still have the tax deduction. The risk feels bigger than it is. That's emotion. The math is different. Let's zoom all the way out. You're 30 years old. You switch to an HDHP. You open an HSA. Your employer contributes $1,000 a year. You contribute $3,000 more. Total, $4,000 per year going into the HSA. You invest it all. You pay medical bills out of pocket. You keep every receipt. At a 6% average annual return, at age 40, your HSA has approximately $53,000. At age 50, approximately $97,000. At age 60, approximately $158,000. Plus, you have a growing stack of unreimbursed medical receipts. Let's say they total $40,000 over 30 years. You can pull that $40,000 out tax-free. At any point, for any reason, after the money has been compounding for decades. That is the strategy. Not complicated, just uncommonly used. Most people compare their 401k balance to their neighbor's 401k balance. Nobody compares their HSA balance, because most people's HSA balance is zero. They spent it, and the ones who didn't spend it, are holding a quiet, compounding tax-free asset that the financial media almost never talks about. Because there's nothing to sell. It's too simple, too boring, too accessible, no commission, no product, no pitch, just a government-approved account your employer already offers that most people treat like a medical coupon. Here's the breakthrough. Wealth isn't usually built through income. It's built through access. Access to accounts, access to tax advantages, access to information. And the maddening truth is, most people already have access to this. It's in their benefits package. It's been sitting there since they were hired, and year after year they walk past it, not because they're bad with money, because nobody explained that health savings account isn't really about health. It's about time, and what time does to money that nobody touches. The person who figures this out at 32 versus the person who figures it out at 52, those are two completely different retirements, built on the exact same salary, the exact same employer, The exact same benefits package. The only difference is one conversation. This one. Open enrollment is coming? Check the HDHP option. Open the HSA. Move it to investments. Keep the receipts. Do it this year. Because the most expensive financial decision most people make is the one they keep postponing.